Let's try that again. Good morning, everyone. Good afternoon, good evening. This is Joseph Trevisani from Worldwide Markets. And if everything is okay with the administrators from that excellent website and resource, FX Street, we can start. I just turned up the sound. Is that better? Okay. To use the 19th century American locution, okay, which has kind of a fascinating history. I don't know if I've ever gone through this before. There's a lot of dispute, although I think it's been settled lately about where that particular phrase came from. It's interesting because it is used worldwide, and it seems to have come from a 19th century American election featuring Martin Van Buren, who was a president in, I think, the 1820s. I'm not 100% sure about that. And he was also known, I believe he was in New York State, which had originally a Dutch settlement around New York, the Dutch settlement. And he was known as Old Kinderhook. And somehow, I guess during his campaign rallies, people started saying, okay. And that got to be a sign of approval. And almost 200 years later, we are still using okay. And now we're not just using it around New York, around the United States. We're using it everywhere around the world. Kind of fascinating, to me anyway. There's a great deal of archaeology in language. Okay. Just check with can everyone hear? I want to make sure that everyone can hear me. So if you can't hear and you have any issues with that, please type in. I will speak a little bit louder. I turned the volume all the way up here. So I will, let me see if I can find the mic control, voice control. Well, I have the volume on the mic turned all the way up. So I hope this is sufficient. Sorry, I'll speak a little bit louder, which maybe will help. Okay? So here we go. Title of today's presentation is The Dollar in Limbo. I'm actually going to write a column on this week. For those of you who have been coming to my webinars since the days of FX Solutions, I used to write a column, which I called Market Directions, a weekly column for FX Solutions, which was also published in a number of places on the web, Real Clear Markets, Global View, a number of other places, also on our website, of course. I'll be starting that up again in September. I'm looking forward to that, actually. I actually enjoyed writing that column, although writing is not the easiest thing for me. I enjoyed writing it, and I enjoyed the feedback that people would give. I also enjoyed having it posted on the web. Just a procedural note. If anyone has any questions, comments, considerations, corrections, anywhere along the webinar, please let me know. Just type it into the chat, and I'll be glad to stop for a little bit and discuss whatever is on your mind. So, dollar in limbo. If we take any reasonable assessment of what is going on in the currency markets, I certainly, I'll speak a little bit louder, but I have both the volume on my microphone and the volume on the system turned up all the way. So I will speak a little bit louder. I hope that. Oh, how's this? Is that better? I'll bet that's better. Yes, I won't tell you what I just did. It will only prove my permanent unfamiliarity with technologies and headsets. I say no more. If we think about what's going on in the currency markets, in the world, I would certainly have a question is what is the dollar doing where it is? Why is the dollar not a good deal stronger? If we look at economies, if we look at interest rates, I mean, unfortunately, even if we look at worldwide political developments with the events in Egypt over the past few days, and you could say the past few weeks, you have yet another cause, you would think, for the dollar to strengthen. Yet the dollar is doing very little. This is a very restricted. I'm using the euro rather than dollar index because that's probably what as traders we're most familiar with. This is the range. This goes back to 2013, but if you want to get, you bring it closer, we've been in about a, even if you take it down to the bottom here, we've had a 6-figure range, but recently we've had a 3-figure range. It just goes back and forth, back and forth. So what ails the dollar? I've long been a proponent of the idea that markets have a scenario in mind. In the French, an idée, is it idée fixe? I think it's idée fixe. A fixed idea about what is the shape of the currency world. And that, like the market cliche that markets can stay irrational much longer than you can remain liquid, that idea, that scenario, the traders use. Or at least, if they don't use, at least it prevents them from taking the greater risks that would involve a breaking of that scenario. Can exist longer than the evidence saying that it is mistaken is already very clear. The best example I have, and that's why this chart is up right here, and the best example in my experience is the euro in the summer of 2008. At which point in early July, Jean-Claude Trichet and the ECB actually raised rates. The scenario at the time was twofold. Well, probably more than that, but let's just deal with two of its items. One was that the ECB really has no problem. I mean, the Europeans really have no problem with the asset-backed securities, the subprime loans that were packaged into them that the American banks do. So their system's going to be fine. And two, they have no real exposure to the U.S. economy. Well, this wasn't what people said, but the idea was that the Europeans could stay decoupled from the U.S. economy if anything ugly happened in the U.S. Remember, the Fed had been reducing rates from 2007, from the year before. So that also was part of it. But markets discount. So yes, the Fed had been reducing rates. But as soon as things would get ugly, if they did, then the Europeans would have to follow. So the Fed's rate reductions were a known fact. The Europeans were the one on the horizon. But at the time, in the summer of 2008, the euro was at 1.6. The scenario that I just spoke about, despite all of the warning signs from the subprime markets, from the credit markets, on and on and on, were ignored. The euro stayed strong, just about right up until the crash. Not quite, a little bit before it. So, I think that we may have a similar type of scenario obsession working right now. The best indicator, well, let's just take it one by one. If we're looking at a trading factor for the retaining strength of the euro, I think there's really one factor, and that's a quite simple one. The market got burned quite badly, I think anyway. I don't know what the P&L figures are, during the last Fed confessional bout about what they want to do with quantitative easing. On May 22nd, let's take a look at a different euro chart here. Okay, this is a euro chart with the purported, I used this in my last webinar, so it's not quite up to date, but it is very apropos, and that's why I'm going to bring it up. This is what happened. This is why I think the euro, in addition to the difficulty in changing scenarios, this I think is the biggest reason why this area right here, is why the euro and traders have been reluctant to pay attention to the signs that are going on in the markets right now, in the other markets, not in the currency markets. The history of the end of QE, or at least the discussions about the end of QE, that's the history right here. May 22nd, in a speech, Mr. Bernanke first mentioned that QE could possibly end this year, or at least it could begin to taper it off this year. That's where taper, not T-A-P-I-R, which is a mid-sized Southeast Asian mammal, I think. Not a marsupial, though. Of course, marsupials only live in Australia. That's not true. A few marsupials live in North America. The opossum, which is very common in this part of the country, is also a marsupial. Sorry about that. May 22nd, Mr. Bernanke first said that they could possibly begin to end QE this year. Nobody paid any attention. June 19th, that FOMC, in the Q&A afterwards, he seemed to confirm. The market suddenly started paying attention. Remember, central bankers are not social conversationalists, at least not in public. If Mr. Bernanke, on May 22nd, although nobody paid attention, the euro went up, said that they were thinking of ending QE, it wasn't because he didn't get enough sleep the night before. It wasn't because his coffee was bad. It wasn't because he thought he'd have some fun and play games with the market. It's because that had become clearly a very serious consideration and possibility at the FOMC. There are no indiscreet words from central bankers. And probably that is my guess as to why on the 19th he reaffirmed that. Suddenly the markets are paying attention. The euro goes from 134 to 27.59 in a little bit more than a month, 5 weeks. Markets were definitely paying attention. But at the same time, U.S. rates, which had been rising, started to shoot up. I actually have the chart here. Let's take a look at it. Where's my Fed chart with my Fed chart. Sorry, looking for it. Fed funds with QE dates. Here it is. The 10-year with QE. Okay? Whoa, what do we have here? This is the problem. It is my belief that Mr. Bernanke and the FOMC is seriously considering, in fact, I think they will, begin to curtail QE, but I do not think the reasons are solely, or even predominantly, because the economy is so much better. The economy is slowly getting better. That's true. And that, I believe, gives them permission, or at least leeway, to do what I think they want to do for other reasons, and that is start to end quantitative easing. As the question is up there, let me make a brief answer on that. What markets do is not act as correct interpreters of economic policy. This is a very, very basic idea which is incredibly easy to forget, especially when you're writing commentary about a market like the currency markets. The primary purpose of markets, at least for the participants, is as a vehicle for making money. And markets will only move when they do two things. They tend to move all at once, and it usually takes a trigger to change a scenario. The trigger in the summer, where's that euro chart? Right here. The trigger in the summer that's the wrong one. Sorry. Where's my long-term euro chart? Here it is. Sorry, wrong one. The trigger here right here in the summer. Remember, the ECB had just raised rates, but the trigger was a very mild statement from Jean-Claude Trichet. He said, Euro growth might not be all, I don't remember the exact words. Euro growth, or the European EMU economic growth, might not be what we expect, or something along those lines. That was the trigger. And suddenly all of the other items out there in the world fell into place. And we got this. 60 to 1.5, 10-figure move. This is a daily chart. That might be a month. That's a very large move. So markets both require the basic facts to have changed, but they also require a trigger, something that suddenly brings things to the fore. Markets, after all, are psychological creatures because they're composed of us. And it needs to become obvious, or it does become obvious at some point, that one, everything has changed, and two, the way to make money is the downside. So that's the trigger we had here. Now, for the euro we have here, you could say we're still waiting. But I have some signs about that what we're talking about here. So we're back. Let me look at back to this. So this is the reason for this. If we look at, okay, this is the euro. So we're back. Let me just go through that again. May 22nd, Mr. Bernanke, by no means inadvertently, says the Fed is thinking of ending QE. While that happens, and Mr. Bernanke should know this, I've always been puzzled by this, but there we go. He's never been a trader as far as I know. What are rates doing? Rates are rising. The 10-year rate, which many commercial rates are keyed on. Now, throughout this period, the U.S. economy is middling, not strong, doesn't appear to be going back into recession. Housing market's getting a little better. People are buying houses. Housing prices are rising. But many of the commercial rates that are in the market that affect the economy are at, through this period here, historical lows by deliberate policy of the Fed, by deliberate QE policy. This move right here, you could just say, is nothing more than a little bit of the bond market coming back, taking some profits. But from here on in, the credit markets, the treasury markets are paying attention to what Bernanke is saying. So, while the euro is going up from this period right here on the other chart, so are U.S. rates. There's a limited amount of logic for that to be accurate. Except the currency markets simply weren't paying attention. The credit markets were. This is not an unknown phenomenon at all in trading markets, particularly the currency markets. So, I think at this point, and from here on up, now this is the point where Mr. Bernanke says at the end of that FOMC, we might actually do this. Whoa, look at the rates. From 2 to 2.6, I guess, in that period. Comes off a little bit. This, of course, is profit-taking on this. There may have been some Fed comments in that period, I'm not saying. And then it shoots right back up again. This is 275. This was 275 intraday and 274 on the close. The highest rates in about 2 years at that point. And today as well. So, what happened on July 10th for this to take place? I think that Mr. Bernanke, and the rest of the FOMC, the idea that they didn't know rates would go up when they started talking about ending QE is preposterous. Of course they knew that. It's unavoidable, inescapable. As you say up there, that the Fed cannot keep QE up forever. But markets don't really care whether it goes or not. Markets don't care about the economic accuracy of anything. What they care about is how they can make money. So markets won't move until there's a sign that the profitability is turning in a different direction. So I think what the problem right here for Mr. Bernanke and why on July 10th he came back and walked back a good portion, it seemed, of what he had said about ending rates. What he said was, we can end rates, we can end QE, we can increase QE. Depends on the statistics. Okay. You can tell certainly from the reaction of the bond market that the bond market didn't really believe him. The bond market knows that the next move in monetary policy, and make no mistake, quantitative easing is monetary policy. If rates are going up, regardless of what the Fed funds rate is doing, and irrelevancy, the only reason that we're even dealing with QE is because the Fed funds rate no longer had any effect. Monetary policy, by any other means, is still monetary policy. And quantitative easing is most assuredly the Fed's monetary policy. So despite the apparent walkback of Mr. Bernanke's earlier, not quite promise, not quite avowal, but hint that QE is on the way out, the bond market didn't really come off very far. Rates came down to maybe 2.45. They're all the way back up now and higher. But let's take a look at the euro market. Wrong one. Well, let's do it on this one. Let's do it on this one right here. Okay. The reaction of the euro market was very different. And this, I think, is the reason for the stasis in the euro right now. Anybody who went short got burned. Look at this rise on this particular day. This was the 10th. That is an ugly move. I guarantee you that people lost lots of money being short the euro that day. People always have a tendency, even professional traders, to hold on to positions, all the sorts of things you shouldn't do as a trader. Everybody makes mistakes. So these 2 days, look at the brutality of this move. Come on, cursor. These battery-powered light mice are not my favorites. Sorry about that. These 2 days, this is a daily chart. Brutal moves in the euro. We're up at 32 from 28 in 2 days. 4 figures in 2 days. It's actually more than 4 figures. Those are stop-loss run dominated trading days. Stop-loss is self-defined. So those 2 days, I think, are the reason the currency markets are not acting right now on what appear to be very concrete, unmistakable signs that the scenario is changing. If we think about some of the reasons behind some of the scenario, let's talk about those for a minute. The U.S. economy. I'm not even going to bring up any charts. I have charts illustrating this, but I'll tell you what some of them are. The U.S. economy is doing considerably better than the Europeans. This is, of course, a standard performance criteria from the past 15 years, actually from the past since the Second World War. Not quite since the Second World War, since the 80s, I believe. GDP is better. ISM numbers are better. Unemployment is better. All of the criteria, U.S. income is better. Retail sales are better. All of the items, the indicators that we look at to assess the health of comparative economies or individual economies are doing better in the U.S. Now, if you have a stationary monetary policy, because after all, the biggest effect, the biggest correlation for currency trading remains interest rates. So if you have a stationary policy, which is what we had largely until the Fed started speaking, the changes in the real economy won't necessarily transfer as changes into interest rate policy if you have a stationary interest rate policy. So until the Fed started talking about the ending of quantitative easing, there wasn't a lot of difference, actually, between the EU and the Fed, regardless of what the statistics, the performance of the individual economies, the EMU and the United States. Yes, the ECB was more likely to cut rates than the U.S. than the Fed, because the Fed can't anymore. But the Fed was running this vast quantitative easing policy. So at that point, the ECB is probably a little bit ahead as far as interest rate translation into currency valuation. Because the ECB has proven to be very reluctant to do what the Fed has done, which is drop rates down to zero, basically. ECB is still at 0.5%. Although, honestly, as far as its effect on markets and on economic performance, I doubt there's little difference between 0.5% and 0.25%. Then, yes, I think you're right. Thank you. That is true. Those moves were actually much quicker and were stop-loss runs. Thank you for that. Than are depicted on my daily charts. They were stop-driven runs. Everybody got burned on that. At least a lot of people, I guarantee you, got burned on that. Because after what's seeming avowal on the 19th that the QE, the end of QE it's what's on the horizon, the Fed walked it back, or tried to anyway. As you can tell, the currency markets had a lot more volatility based on that than the credit markets did. Because I don't think the credit markets really bought it. Because the credit markets have a much longer view. They're probably the most rational of all the markets because of that. And they know that if the Fed started talking about the end of QE, there's only one reason. Policy views on the FOMC have shifted. So they had a much more rational view about that. Okay, so we talked about markets and rationality and irrationality, which is why markets are fun. And some of the reasons for the direct reversal in the euro. Another thing we should look at, which I don't have on this chart, but we know that the euro went to 134. The reason for the move in the euro, and I actually listened to Robert Sinche, who used to be at Stanchart. I heard him on a local program here called, we all know Bloomberg, but Bloomberg Radio. They have a brilliant program in the morning from 7 till 10 called Surveillance. And he's a very well-known currency analyst. I think he's gone to a private, he worked for a bank. Anyway, it was his contention, and I think he's absolutely right, that the move in the euro from July 10th up until it reached 134 was simply a reversal of the previous move. There was no change in scenario. There was no change in view. And there was really no trend established. And I agree with that completely. The bulls were gored. The dollar bulls were badly gored by Mr. Bernanke. But they did not take any new positions. If there was really a new scenario that was developing by what Mr. Bernanke said on the 10th, why would the euro have stopped at 134? It wouldn't have. If what Mr. Bernanke really went to say is, you know what, I made a mistake. We all made a mistake. We had too much to drink at the FOMC summer annual picnic the night before, the day before. We shouldn't have said this. We're going to keep QE up forever. We didn't say that, and nobody believed it. Even the currency markets didn't believe that. Certainly we know the credit markets didn't, because we took a look at the credit, what the 10-year did after July 10th. So there was no change in outlook. There was no change, there was no establishment of a new trend because of what Mr. Bernanke said on the 10th. And the euro went right back to 134, and it's been basically trading between 134 and 132 since then. Two figures is a very small range over time. We all know that cannot last. So, I wrote down this phrase earlier. I think maybe I'll use this in my column. The bond market, which clearly is telling us. Let's take a look. Let me get today's, let's see what the date is on this. Okay, this is a daily on the 10-year. This point back here in July was 275, intraday 274 close. We don't have a daily close yet today, of course, but it was at 278, I believe, yesterday. Okay, this is the intraday chart when I came in on the 10-year. And why do I keep emphasizing the bond market? For two reasons, which I both mentioned, but I think they're worth repeating. The bond market has the longest view by a necessity of the instruments that it deals with, 5, 10, 20, 30, 2. And it is, because of that, the most rational, in my view, the least emotional. I won't say that about the currencies. Currencies tend to be rather highly emotional. So this is today. This is an intraday 30-minute. Actually not. It's a 3-month intraday. No, it can't be a 3-month intraday. It's a 3-month 30-minute chart. Today's peak was 2.8. It's now, when I put the chart in, it backed off 2 basis points, basically, a little less than 2 basis points. It did reach, thank you, that must have been after I came in here. So it actually reached 2.83. That's the highest rates in more than 2 years. The bond market's view is clearly, now, the bond market's view is very clear. It may be wrong, but they're going to have to be proved wrong in September. And even if the Fed does nothing in September, I doubt very much. There'll be some profit taking in the bonds, but I doubt there'll be a trend reversal. Unless the FOMC comes out at the next meeting and says, you know what, 85 billion is not enough. The economy is really in bad shape. We're going to 100 or 125. That will cause a trend reversal in the bond market. But clearly, the bond market is not betting on that. This changed. Let's take a look at the last time we were at anywhere like this. Let's look at the U.S. 10-year. Let's see right on this. Okay. You know what? I may not have a long enough chart on this one. Sorry about that. I really don't. My apologies. I did check it before I came in, though. It's I believe the last time it was at 2.8%, and the 10-year was August 8th, 2011. Years. Okay? Now, if interest rates have the greatest correlation to currencies, which they do, there is no euro bond. There are German bonds. The U.S. is now a full point over German 10-year Bund. The euro is still sitting at 3.25 or wherever it is. Take a look at the French. 2.41 now. Again, the U.S. has almost half a point edge over the French bond, the French 10-year. Yet, the euro still has not moved appreciably. We're still sitting right here. Let's look at some of the reasons why that could possibly be true. Again, I had next on here, but I would discuss it, but I'll just go through it again. Remember, interest rates are higher and rising in the U.S. They're not rising in the EU. ECB, whatever they're going to be doing, they're not going to repeat Mr. Trichet's faux pas. I have my few French phrases out here. I took 17 years of French, but I won't say that my proficiency is very high. It's probably pretty low. Probably in about a year, my little kids will pass me on my proficiency in French. When I go to Paris, I'm going to have to get my 6-year-olds to do the translation. If you look at almost any econometric comparison between the U.S. and the EMU, GDP, unemployment, ISM numbers. I'll show you something. We can take a look at the ISM numbers. I have them here. Hold on. Let me just get them here. U.S. manufacturing ISM, 30 years, 5.555. Where is my EU? EU numbers. EU manufacturing PMI, 50.3. All this time was beneath. You look at services, we have the same thing. Services, EMU. Oops, that's unemployment. Sorry. Right here, EMU, 49.8. Take a look at the U.S. services. Any criteria you want to look at, the U.S. is doing better as far as economic statistics. Here's another indicator. This is an intraday tick chart from today. There were two statistics out that the market seemed to have paid attention, currency markets paid attention to today. At 8:30 was jobless claims. You know, jobless claims is a trend, is a trend. It's a complete trend number. It doesn't really matter very much what the individual week is. What matters is the trend. The trend has been positive. There's no question about it. Today's number was, I think, 320. Correct me if I'm wrong. Expected was 335. 8:30. This is 8:30 right here. So we had almost a 60-point drop in the euro on a statistic which, one, is a trend number, and two, didn't really offer any new information. The jobless claims have been on an improving trajectory for 3 years now, maybe more. They are getting to levels right now, especially in the forward moving average, that have normally, at least historically, been associated with pretty robust job creation. There is no robust job creation right now. There's middling job creation. So we still got a 60-point improvement in the dollar against the euro on this basically no information statistic. At 10 o'clock, we had the Philly Fed, which is a manufacturing survey in the Philadelphia area. Well, the Philadelphia Fed area, which, if I remember, is southern New Jersey, Delaware, and most of the eastern part of Pennsylvania. I think that's it. Not a major manufacturing area anyway in the United States, although certainly Pennsylvania was in the 19th and well into the 20th century for coal and steel, but it is no longer. Many of the steel plants, the more modern and efficient ones, have moved down south, and the whole labor union story is probably part of that. So after 10 o'clock, we got about a little bit more, a 20-point rise on a very unimportant, or largely, comparatively unimportant, manufacturing survey. That tells me that the attitude in the markets is shifting amongst traders, that it's becoming clear that the euro at these levels will prove unsustainable. That is what this particular section of this chart tells me. Now, it hasn't done anything. We can take a look at the euro, of course, but it hasn't done anything to break the euro out of this range. And it's going, in my mind, two things are possible here. One, we're going to have to break through some major technical levels, one actually being 1.3 and the other one down here. The other one is right about here, which is 132. You look right about there. And we haven't gotten there yet, although we did get down to 0.4 today and it bounced back. That also looks to me, I think it did. Let's take a look at the that intraday chart again. I think it got to 0.4, 32.04. That could be 0.4. I'm not sure. It might be 0.5. But it did. It got very close to 32. 32 is probably the next major technical level that the euro is going to have to breach before it gets it. But really what we're waiting for, of course, now, a sociological note, with myself as an example. This is my last work day for 2 weeks. I'm going on vacation. I believe most of Europe is already on vacation. So the two of the major centers in the world, the European and the American, do not have their usual complement of traders, hedge fund managers, and the rest. Many of the instructions, I'm sure, that are left on the trading desks are don't do anything rash, don't take any big positions, cover, and get out. That's certainly what I was told when I was a junior trader trading back in the mid-90s in August. Don't do anything rash, just as you were told in December, except in August you still have to make customers who come in, and in December you do not. So that's another reason I think we have some sort of stasis right here. The people who might be inclined to take these positions are probably out in the Hamptons, at least in New York. The other reason is that the Fed has deliberately introduced some ambiguity, into its monetary policy. The credit markets are not buying it. I mean, unless Mr. Bernanke comes out, I don't know where he takes his vacation. He lives in D.C. I don't know where they go. Maybe they go down to the Outer Banks in the Carolinas. I don't really know. Is he from New York? No, he is not from New York. Anyway, although I think I mentioned once before, when he was going into college, the SAT perfect score, that's an American standardized test that almost all college students, prospective college students take. It's both knowledge and intellect, I guess, and it's part of your admissions to any college. When he was taking the test, he's late 50s, maybe 59, 60, something like that. When he was taking the test 43 years ago, perfect score was 1,600. I believe Mr. Bernanke got 1,590. So he certainly knows that this was going to happen in the credit markets when he started talking about it, as soon as the credit markets started paying attention. I think the reason he started to walk this back here was not that he did not want and didn't know that the credit markets were going to raise rates when he starts talking about QE. That's preposterous and it's not true. He didn't want the credit markets knowing that the credit markets, especially the bond markets, were close to historical highs because of Fed policy. That there has to be a huge amount of profit sitting on the table that bond traders are going to want to book. That it was very possible that the credit markets, the treasury markets, got far ahead of themselves, that they started running through stops, that rates started shooting up rather than just rising. And this itself, what we're seeing here, is a very sharp rise in treasury rates. Very sharp. Not quite ahistorical, but very sharp. I think what happened here, especially if you look at this rise back up, what does this tell you? That as soon as we got to a level where there was some sort of stability, everybody started selling treasuries again. That's what that very sharp rise is telling you. You saw a bit of stasis, a bit of stability, and then when it became pretty clear, you got pretty much back to the bottom here when it shut up. So I think what was going on here, and the reason he started to walk it back in July, was that he was afraid the markets were going to get ahead of themselves dramatically. And for a weak economy, which the U.S. has, it's not as weak as the rest of the world, but it is weak. And it's a kind of weakness because a lot of it is psychological. Or a good portion of it is psychological. At least there's a lot of concern out there that it's very, I think, susceptible to shocks. More so than would normally be the case in a business cycle, if we were in a business cycle at this stage of recovery. Actually, if we were at this stage of recovery, considering what we went through, we'd already been way over the peak and probably headed back to another recession in years. That's not what we're seeing now. So I think, I'm sure actually, that the reason he started to walk it back here in July was because he was afraid it was going to shoot up. And that kind of very, very rapid increase in above the 2-year level, don't forget where we are in the 10-year, could actually have delivered some shocks to the economy, and that's what I think he was worried about. But, if you look at as I've said several times, the 10-year, it doesn't look like the bond market is buying any of that. Okay, so now let's make another comparison. When it comes to markets rates, I talk about this. I'll just talk about those things briefly. There are two kinds of rates there are two kinds of rates, of course. Normally, if you take a look at the Fed fund rate, this is a 10-year on the Fed funds. Okay? Remember, 2007, Mr. Bernanke started dropping rates. Right here, almost a year later, Mr. Trichet is raising rates. Ooh, one of the great classic. It's not a malapropism. I love that word, but that's not what it is. One of the great mistakes, of course, in central bank history. At any rate, this is normally the type of thing that keeps on market rates. Market rates key on what the Fed does. That is not what's going on now, courtesy of QE, as intended. So there isn't a lot of difference between this, as far as current rates go, and that's the Fed funds. Sorry, folks. Need to come up with a better way of doing this so that we get. That's my Fed funds. Did I not put up the ECB rate? I thought I had the ECB rate here. Sorry. Hold on. Euro. Well, I guess not. So I apologize. I only have the Fed funds rate. I don't have the ECB rate. But anyway, we know the ECB rate. The ECB rate is 0.5%. So there isn't any real difference between the two policy rates. But we did look at the 10 years, and I'm going to flash through them quickly. This is the Fed funds 10-year. Oops, no, it's not. That is the Fed funds. Yes, sorry. Come on, computer, catch up. This is the U.S. 10-year as of about a month ago. This is the German 10-year. They've also, now you see some response here, of course. The German 10-year is rising right with the Fed. How about that? But there's nevertheless more than a point disparity. So it isn't so much now because interest rate markets are no longer keying on the policy rates as an indicator of central bank policy. They're keying in the U.S. on QE. And the German rates are just following. So that's where we are. Okay. Now let's deal with quantitative easing. And why would the Fed be considering ending this policy? If we admit, and I think we have pretty much established, that whatever improvements there are in the United States, this is GDP, very unimpressive. This is average hourly earnings, not very healthy. And these are U.S. figures. Non-farm payroll, 20-year, not terribly impressive. Certainly, when you compare it to, and I couldn't get this chart back to the 80s, which are more striking in their difference. But then you have to remember, this chart itself goes back 15 years. The U.S. population is not static. It has grown in the past 15 years. My guess is by 30 million, around 10%. So you have to factor into this, much like opportunity cost. And not only is it performing very poorly on a historical level, there's no improvement in the absolute numbers just based on population. So all in all, a very poor performance in the U.S. There's just no getting around that. You can say what you want about policies and about anything, and in politics, there's simply no arguing at the fact that the U.S. performance after this recession and financial crisis, for whatever reason, has been very poor. This is another awful chart. This is labor force participation rate. Those of you who came to my last webinar saw this. One of the standards that Mr. Bernanke keeps talking about is, matter of fact, he supposedly keyed rate changes to it, but I don't believe that. Unemployment. What's called the U3 number. That's this number right here. Where's the U3? It's the 30-year U3 chart. Okay? The unemployment rate. Well, we all know, but I'll repeat it anyway for those who may not. The Department of Labor counts you unemployed only if you have looked for work actively in the prior month. Other than that, you don't get counted. This fall, from probably about here on down, is because of this. People stop looking for work. People are participating in the labor force. That means counted as looking for a job, but not having one, is at the lowest level since women started joining the workforce in large numbers in the 70s. That is the reason that the U.S. unemployment rate is 7.4%. It has nothing to do, or very little to do, with job creation in the United States. Okay, so what possible reasons could Mr. Bernanke have for wanting to end QE? And I think there are basically two. Now, one of the things, of course, that I mentioned earlier, but I'll mention again because I have it here in a different section of my presentation. When the bond market began to move, the prices moved down and the rates moved up after Mr. Bernanke's two comments, especially the one on June 19th. He knew, and he had to know, and I guarantee he thought about it, the huge, long positions in the bond markets. I mean, positions of people who are not going to hold those bonds until they mature, for whom this is a trading event, that if they don't sell those bonds, they're going to get nailed on the return. There are big, and are still, I believe it's the biggest, actually it's not as big as the currency markets in turnover. I'm not sure. Anyway, it's the biggest bond market in the world, the Treasury market. So if that market starts to move, and as I said, starts executing stops, there could be a huge rush of rates higher. That could be very damaging to the economy. The Fed is aware of the size of positions that are outstanding in the markets, and so I think that's one of the big reasons that we walked that back. So we didn't get that much. So why do I have a chart of the Dow if I'm talking about reasons that the Fed might want to end QE? In fact, I think they have decided to taper QE. I don't think they're going to end it. I think they're going to taper. But remember, once that fact is confirmed, and that's the other reason I think why the currency markets are in a bit of a pause here. Having been burned once, fool me once, shame on you. Fool me twice, shame on me. You may get some movement. I mean, I think gradually the euro is going to come off over these next couple of weeks at the end of the summer. But unless we get some other developments or we do get some real moves on some of these stop levels, I'm thinking more of 30 than 32. I think the markets are probably going to make only gradual moves and no real scenario changes, even if behind that I think it has already changed, until we hear from the next Fed meeting to see if the Fed actually does something. I don't think that will change the bond market's mind very much. I think it will perhaps engender some profit taking, some buying back of positions that have been shorted in the bond market. But I don't think the bond market is going to change its view, because I think their view and my view certainly is that I can sit here and speak for the entire bond market, is that the next policy move, with the information we have now, with the scenario we have developing us now, whenever it takes place, and I still think it's going to take place in September, will be the tapering and curtailing and ending quantitative easing. I don't think that's changed. I think the Fed has made up its mind. Okay, so some of the reasons why the Fed, I think, is ending QE, because you can make an argument. Well, the economy is weak. The economy is weak. Why end QE? What's the purpose? I mean, it's only going to drive rates up. Everybody knows that. Rates are only going to be higher rates in mortgages, and all of the rates associated with the economy are going to be, considering to where they've been, are likely to be a drag on economic growth. So why do this? Why not just keep buying QE forever? I think what's happening is quite simple, really, and logical. Two things. One, QE is not really very effective. It's never been terribly effective, and I think its efficacy is diminishing greatly. There is a study out, which I heard about this morning and have not read. I think it's available publicly, from the San Francisco Fed that basically says the quantitative easing's effect on the economy, if not negligible, is subject to serious diminishing returns, and we're long past the point where the returns have or are of any appreciable effect or positive effect on the economy. But still, you can make the argument that, okay, it's really not doing very much positive for the economy. It's still doing something. So why end it? Because there is, of course, another side. There's a balance. Artificially phony rates, which is what the economy has, courtesy of quantitative easing, are not cost-free. And that's why I have this chart up. The U.S. economy, the Dow, as a representative of the U.S. economy, recently reached all-time highs. Higher than the great bubble right back here in 2007. How could that be? The U.S. economy is growing sub 2%. Income, sales, job, almost any measure you want to look at does not correlate with the Dow reaching all-time highs. And this, I think, is what the Fed is worried about. There are, don't say it too loudly, bubbles everywhere. Oil. Oil is actually, let me give you the flip side of this. If I say that the Dow had a bubble, look at this. This is the Brazilian, I don't know how to pronounce it, okay? Bovespa, I think. I do not speak Portuguese. Had a really dramatic fall from May and June. This is right about May 22nd. I don't have the date on here. Looks like whoever was investing in the Bovespa was paying attention to what Mr. Bernanke said. This is the real. Looks like whoever was investing in the real was paying attention to what Mr. Bernanke said. I'm going to repeat myself here. This is Sensex, India. Looks like, I believe had a bit of a rise here. I don't know what that is. I didn't actually check this out. Anyway, looks like, say, we're paying attention here, and this is even worse, the rupee. A lot of the money, not a lot, but a certain portion of the money that hedge funds are chasing around the world, and others, I'm just going to pick on hedge funds, looking for return, has gone, guess where? Into emerging markets. That's why the Bovespa has done this. That's why the real has done this. Because, one, people are investing in foreign currencies, and two, I checked out I looked up the Indian policy rate yesterday on the rupee. You know what it is? It's 7.25%. It has a 7% advantage over the U.S. policy rate. I did not check out the 10-year Indian bond. I suppose I should have. Maybe disparity is not that high. India yesterday actually wrote this up. It's on our blog and on our Facebook page. And India put in some domestic capital controls or capital controls affecting domestic accounts. I don't know what it is. Indian companies can invest overseas more than 100% of their net value, net worth without permission. And before that it was 400%. And individuals can only remit overseas 75,000 a year. It used to be 200,000. Those are going to have absolutely no effect on the euro. On the rupee. Because now in a currency like the rupee, the percentage of volume due to actual trade is probably higher than it is. I don't have proof of this, but it seems like it would be true. Is higher than it would be in a currency such as the euro, where the vast, vast, vast majority is speculative trading, as it is in the currency market in general. So it may have a little bit of effect, but it doesn't affect foreign companies. Doesn't affect foreign individuals. So its effect on the rupee is probably going to be negligible. The reason for this is because many investments were called home. One of the big factors, the foreign overseas investment in the Indian bond market dropped by 10 billion from 38 to 28 over about a month and a half period. That may not seem like much, American Treasury market standards, but it's a third or almost a quarter. Sorry, a little bit less than a quarter. So that's the effect. This is the mirror image of this. There's my Dow chart. Where's my Dow chart? Sorry. I'm going to have to end soon. I just want to wind this up. Where'd my Dow chart go? Hold on. I'll find it here. Here it is. Okay. Not great. Okay. What's happening is that what the fancy term is financial repression, the artificial inducement for rates to stay low, is creating all sorts of misallocation in the world financial system, primarily the United States as well. It's not only affecting the United States, it's clearly affecting India and Brazil and many other countries as well. It is my opinion, although it's difficult to prove it, that the inability of the U.S. to produce jobs, or at least large enough numbers of jobs and economic growth to get out of the economic job hole that we've been in since the financial crash, is because of the misallocation of capital. Now, part of this is, of course, policy considerations out of D.C. that is beyond the consideration of this webinar. But when you distort, much like, Freudian analysis, an obsession will always find its way to be expressed. When you distort the natural market mechanisms for whatever purpose over long periods of time, it distorts the economy. There's another example right here. So it is my contention that some portion of this, an unknown portion, but a portion that we may be about to find out, is bubble-induced. Is Fed credit bubble-induced? Let's take another one. Where's the Case-Shiller number? These are housing starts. This is Case-Shiller house prices. This is a relatively new statistic. Those are year-on-year price increases nationwide. Where are we? We're back in bubble territory. This was the Great Bubble. Now, it went on for, if you look at here, basically 2 years, but you could stretch it back here. You could say 4 years of almost probably 10% average prices. 4 years, 10%, that's 40% increase in your house price. Cool. As long as you sold at the top and didn't buy on the way up, which is what most people did, which is why we were in the problems that we were in as far as the subprime market, mortgage market goes. This, I think, is another issue for, I think the historical rate is somewhere around 4%. So this is another issue for the Fed. The Fed is not going to come out and talk about these things. He said, the economy is not doing real well, but we're getting bubbles here. The Dow's in a bubble. Oil, we'll talk about oil if you want. Oil's in a bubble. Housing is headed for a bubble. A couple of years of this, and you're right back here. So I think all of these things have made the case to the Fed that QE needs to begin to end. If, of course, the economy starts in the next, to the end of the year, starts to seriously falter, I think the Fed would probably, as they said they would do, they would change their mind, they would change their policy. That itself would be a dangerous admission for the economy. It would certainly affect business outlook. It would undoubtedly affect job production. I guarantee it would fall off. It would affect consumer confidence. It would affect retail sales. If the Fed suddenly starts coming, you know what? As I said earlier, the only thing that's going to reverse the current trend in the bond market is the Fed to come out and say, you know what? Things are grim, and we're upping our QE to 150 million a month, 150 billion a month. Everyone would get panicked, and two, it wouldn't have any effect anyway. When the Fed looks at the balance and says the policy is now largely ineffective, and it is creating, to a degree that we can't determine, dislocations, misallocations of capital, and probably bubble effects in various markets, the balance comes down on end QE. For the Fed, of course, one thing that it can't do is get dramatic about this. It must do it gradually. So we could quite possibly see more walking back of a policy that appears to be already determined from the central bank. But then we go back. I'm going to end in about 2 minutes. This is my peroration. That's a fancy term about speech, and meaning the end, the remarks you make just before closing. So let's take a look at the euro yet again. The scenario that I've outlined in the other markets, of course, requires proof, meaning the Fed has to do something in September, because that's the date that everyone's looking for. I don't know where the euro is right now, at any rate, because I'm sitting here in the webinar room. But I believe, it is my view, that the euro will fall, or to put it another way, the dollar will rise against most of its counterparties. Maybe not the Aussie so much, because the Aussie's already had a huge run, but that's likely not based on what's going on in the dollar, but that's based on what's going on in China. So if you look at the Aussie in particular, you have two possibilities. One, that China slows more than people think, and the Fed does end QE, in which case you have a double whammy for the Aussie, in that it will fall because of China and it will fall because of the strengthening dollar. Or you have a possibility where China, which the last set of figures were actually improved a little bit, where China does not falter and the U.S. does improve, in which case you have a smaller move down in the based solely on an improving dollar. And in fact, you might actually have a counterbalance. You could have the Aussie wanting to rise because China's improving, and the Aussie wanting to fall because the U.S. Rates are going higher and the U.S. is improving, in which case you might get not a very large move in either direction. Although I think that China would have more of an effect, and so the Aussie would probably rise at that point. At any rate, it's my view that towards the end, that as we move into the year and the Fed puts reality to this policy possibility, that the scenario in the euro will inevitably change, and the scenario for the dollar will inevitably change. It will mean that the U.S. is on the upward slope of a rate cycle. It will mean that we have ended the rate stasis of the past 4 years. That even if the policy tool that is changing, be it quantitative easing, is an unusual one. The effect, regardless of what is going on with policy rates, is still the same for the economy and for the markets. I think you will also get, as the Fed moves forward, you will get further re-emphasis. Part of this is due to listening to Mohammed El-Arian of PIMCO this morning on surveillance. I have enormous respect for his analysis. He's the first one, I believe, who came up and coined the phrase a new normal back in probably 2009. And that has been the most accurate description, short description, of the change in the U.S. and the world economy since the financial crisis. Flat out, correct, period, still applies, still true. That what the Fed will do to avoid the huge rush up in U.S. rates, which will be damaging to the U.S. economy, is to repeatedly emphasize forward guidance on policy. Now, honestly, to the U.S. economy here and now or in the next year, does it really matter whether the Fed is promising to keep the Fed funds rate at 0.25% for 2 years or 22 years? It doesn't actually make any difference to the functioning and the rate environment in the U.S. economy. But it does make a difference to the psychology of the markets, the psychology of the bond market, which actually controls economically important rates. Okay, folks, I thank you very much. I've run over a bit. I imagine, since FX Street did not ask me to end, that it being vacation time in Europe, the United States, and everywhere else, that there's may not be another webinar following this. I thank you all. Oh, there's one other thing that I want to mention, which I forgot to mention. Another reason, this is only my personal view, I think it has some bearing, of why Mr. Bernanke and the FOMC, but particularly Mr. Bernanke, would want to put an end, the beginning of the end, in place for quantitative easing. And that's that Mr. Bernanke is a historical figure. Quantitative easing will forever be associated with his chairmanship of the Fed, period. I feel, my view, that if that end to that program, remember the Fed is like a huge tanker. Credit policy changes very slowly. It takes a long time to get that ship headed in a different direction. But if the Fed, under Mr. Bernanke now, he's only going until the end of January, and he's not being reappointed. I actually thought President Obama was a bit, how shall I put it, indelicate in making that statement that he said about 6 weeks ago, where he stayed longer than he wanted and longer than he intended. It's my view that Mr. Bernanke's tenure at the Fed will be viewed historically in a very positive light. At any rate, whatever chairman, whoever is appointed as the Fed chairman, starting with their tenureship starting in February, will be an easy money character. That if the Fed, under Mr. Bernanke, does not get an end to this quantitative easing policy in place, making it much more difficult for the Fed under a new chairman to then come in February and say, you know what, we changed our minds, I'm new. That will be very difficult to do. So I think there is that reason. Why do I say Mr. President Obama will appoint a easy money chairman? Well, the only people who have, although Mr. Summers, I think, has said recently that he has some doubts about the efficacy of QE. If I were him, I would not say that in public or in private. President Obama is an extremely political president. I mean, that sounds silly, but I'll just leave it at that. He is and his party are absolutely looking towards the 2014 elections. And anything that they can do to help them, such as a better economy, is something that I think they will look to enact. So you're not going to get anyone who does not believe in quantitative easing. I think Mr. Bernanke, if I can figure that out sitting here, certainly Mr. Bernanke can figure it out sitting in his office at the Fed. And that's another reason, although perhaps a minor one, perhaps not such a minor one, But I think the Fed under Mr. Bernanke is looking to end policy. Okay. I thank you all very much for attending. I know it's high summer. I take it as a compliment that people would take their time out to listen to me whenever they listen to me. I hope it was instructive. I hope it was informative. I never hope that it's funny, although sometimes I try. And I will see you all in September when we start up this again. If you have any comments, criticisms, jokes you'd like to share that I can use next time, please let me know. I will put my email address and send it to everyone. Again, I thank you very much for attending, and I hope it was entertaining at the very least. Take care.